How does Ijara compare to Musharaka in halal mortgages? If you are curious about how Ijara and Musharaka stack up against each other in the world of halal mortgages, you are in the right place. Let's break down these two Sharia-compliant home financing models and see what makes them unique. Ijara is a lease-to-own option. In this arrangement, the Islamic financier buys the property and then leases it to the buyer. The buyer makes regular lease payments, which contribute toward ownership. However, the financier retains ownership until all payments are completed. During the lease term, the buyer does not have full ownership rights but can use and occupy the property. Typically, Ijara involves two contracts, one for leasing and another for purchasing the property at the end of the lease. A downside to Ijara is that it can feel like renting until the buyer completes all payments. The buyer must continue payments even if the property value changes or personal circumstances shift. On the other hand, Musharaka is a partnership model. Both the buyer and the financier jointly purchase the property and share ownership from the beginning. The buyer gradually buys out the financier's share through monthly payments. This means the buyer has partial ownership rights throughout the financing period. If the property appreciates in value, the buyer benefits proportionately. Conversely, if the value decreases, the buyer shares in that loss as well. Musharaka is often seen as more equitable because it shares risk between both parties. Additionally, it usually features a non-recourse structure, meaning the buyer is not personally liable beyond the property value, which can provide some protection during tough financial times. From the perspective of Islamic finance, Musharaka is often favored. It aligns more closely with the principles of risk sharing and avoids the characteristics of conventional interest-based debt. While Ijara is compliant, it may be seen as less ideal since it keeps ownership with the financier until the end and can resemble a lease with fixed obligations. In practical terms, Ijara might attract buyers who prefer a straightforward lease-to-own model. In contrast, Musharaka may appeal to those who want gradual ownership and shared risk from the start. Both options avoid interest and comply with Islamic rules by structuring payments as rent or partnership shares rather than loans with interest. In summary, Ijara involves leasing with ownership transfer at the end, while Musharaka features joint ownership and gradual buyout. Musharaka is generally considered more aligned with Islamic finance principles due to shared risk and ownership, while Ijara is a lease-based model with ownership retained by the financier until full payment. Both provide halal mortgage options that comply with Islamic finance rules.